Hi, welcome back, and you'll be surprised to see that Tally automatically calculates all those ratios that we calculated by hand. And of course, that was not a waste of time, that was starting from the raw. So this figure right here, that is ratio analysis, or you can click on R. That is the hotkey. Let's go to ratio analysis, enter, and yep, you can see right here that what it has to offer. It has working capital. Did we calculate it right? Let's go to our sheet. 2055. Okay, so this is correct. Cash in hand, bank OD. Okay, these are not the ratios. Current ratio, let's see. Current ratio, is it correct? Yeah, 12 is to 1. Good. And quick ratio, is it correct? Okay, 11.5 is to 1. Debt to equity ratio. Okay, now this has only taken long-term liability. So people sometimes take total liabilities and sometimes they take long-term liabilities. We have taken total liabilities. That is why our answer might vary. Yeah, that is why it is 0.23 is to 1. Total liabilities upon total stockholders equity. See, oops, we did something wrong here by making that thing. Okay, so 0.23 is to 1 is our debt to equity ratio. That is total liabilities. You can choose only long-term liability. Gross profit percentage is 30%. Net profit is 5.04. This is our net profit percentage, 5.04 right here. Okay, and there are some other ratios that are operating cost. 94% is our operating cost, hence too high. This here you can see is receivable turnover in days. That is how much time, that is the debtor's performance. Okay, we had one ratio for it, and what was the name of that ratio? Accounts receivable performance. So yeah, you can see that this was our 1.46. And do we have something else also? Nope. We had one 365 days. Okay, but that is different. So yeah, receivable turnover in days, 379 days. And as soon as you open it, you will see that 366 days, 339 days, 581 days. That is the payments, that is the average amount of payment that they will pay their dues in. And Tally has calculated it how? By their past record. So how come is our account receivable turnover ratio this much? Net credit scale is this. Okay, looks like 32411 net credit sale. Okay, yeah, maybe something different. So that is the limitation of a ratio. Okay, return on investment, ROI. It is also one of the most important ratio after ROE. And how do you calculate ROI? ROI is calculated, that is net profit upon capital account plus net profit. Looks like it. Okay, let's see what is the return of investment. Return on investment 0.77% only. Net profit is 229. Capital account is like 3 crores 5 lakhs or something. And then again net profit, then multiplied by 100. Okay, so let's do it tentatively in Tally calculator. That is 229158 or something profit, divide by 305. Let's take it in round figure, plus 229. Okay, okay, let it be as it is, and let's open our calc and I'll show you. Then go to this figure, that is net profit upon capital account is Our return on investment, obviously 229158 is our profit, divided by the capital right here. How much is the capital? 295. Oops. Yeah, divided by 295,38500 equal to into 100. Oops, into 10. Yeah, into 100 is 0.77%. Hence the ROI comes to 0.77%. That is the return on investment. Okay. And whose investment is it? Capital account, that is the equities investment. Now what return on working capital, that is net profit divided by working capital, 1.11%, 229158 divided by 205. Okay. Working capital turnover ratio, that is sales account divided by working capital. Inventory turnover ratio is sales account divided by closing stock, but we calculated it in some other way. Yeah, we had some other formula, I don't know why. Sales account divided by closing stock. Instead we did cost of sales divided by average. So yeah, it doesn't matter, there are various standards for each and every ratio. Now one thing that you should do is, whenever you analyze this ratio, this is only the analysis part. Okay. And the audit part, that is carried out how you have to open each and every ledger and track a transaction like for cash. So you can see that there is a 2 lakh entry in cash, that is why the cash is high. This is how you do the audit part. Okay, so analysis goes hand in hand with audit, and if there is no audit, you will there is no point of analyzing. So we are done with the analysis here, and yeah, I'll see you in the upcoming lectures. Good day.